Thank you for joining me on this video. My name is Rodney Constable. I am a former financial advisor, a former vice president of a major mutual fund company, and I am the president and founder of Simple Market Signals at simplemarketsignals.com. Today we will be doing technical analysis on the S&P 500 for the week ending Friday, July 24th, 2020. And for this analysis, we will be using stockcharts.com. That is the charting service that I use and pay for, and I will leave a link to their site in the description box below this video. For the week, we were down 28 basis points on the S&P 500, and we closed at 3215.63. And also for the week, we once again, of course, closed above 3,200. And as we can see here, this was the second week in a row where we have been able to close above the 3,200 level. That is very important. And in the entire history of the S&P 500, there has only been 12 weekly closes, including this week. There's only been 12 times in the entire history of the S&P 500 where on a weekly basis we have closed above 3,200. So this is extremely important, and hopefully we can continue to close above 3,200 going forward. That will be very important if we're going to keep this rally intact. The next chart that we're going to look at is an hourly chart of the S&P 500 starting on July 1st, and the blue line is once again set at 3,200, just to really drill down on the importance of the 3,200 level on the S&P 500. So let's start on July 15th and then work from there. And what we can see here is starting on July 15th, you'll notice that we have not had one candlestick, not one hourly candlestick that is closed beneath the 3,200 level on the S&P 500. A couple of them came close, but you can see just how important it is that we stay above this 3,200 level. And then if we go over to July 13th, we can see that the 3,200 level did not hold, and you can see how quickly we can fall. If that level does not hold, we can see how quickly we can fall beneath that 3,200 level. And then we came back on the 14th, and you can see that we stopped right at the 3,200 level. And then, of course, on the 15th, we were able to get back above it, and so far we've been able to stay above the 3,200 level on the S&P 500. So I hope you're seeing just how important this 3,200 level is on the S&P 500. And if you're not convinced yet, wait till you see the next chart. The next chart that we're looking at is a one-day, one-minute chart of the S&P 500, and this is for Friday, July 24th. And what we can see is, if you look at this blue circle, we came down for less than a minute and kissed the 3,200 level on the S&P 500. Look at that on this intraday chart. Okay, again, each one of these candlesticks is 1 minute, and you can see here, I know it's really hard to see, guys, it's really small, but look at that, how we came down and for less than a minute kissed that 3,200 level and bounced off of that, and we're able to trade a little bit above that into the close. So even though we were negative 62 basis points today, Friday the 24th, on the S&P 500, you can see that the 3,200 level, even on the 1 minute charts, is holding up. So I hope you really understand the importance of this 3,200 level, and if we are going to keep this rally intact, we really do need the market to stay above, the S&P 500 to stay above the 3,200 level. If it falls beneath 3,200, we're probably going to trade somewhere down into 3,100 or even 3,000 on the S&P 500. The next chart that we're going to look at is a 2-year weekly candlestick chart of the triple Qs. Of course, that's the ETF that tracks the NASDAQ 100. And what we can see here over on the right is that this is the second week in a row where the triple Qs have turned in a negative performance. We've been down 2 weeks in a row now. We were down 1.53% again this week on the triple Qs. Not a huge amount. However, you can see that this is in the entire rally since the market bottomed on March 23rd. This is the first time that we've had 2 weeks in a row where the triple Qs have been negative. So it looks like we're starting to lose some of that tech leadership in the markets. And if that is the case, it is going to be very difficult for these markets to continue to move forward if we do not have tech leadership. So if Amazon and Microsoft and Facebook and Google, if these stocks continue to roll over as they have over the last couple of weeks, it may be very difficult for this market to continue to move forward, and it may be difficult for the S&P 500 to stay above that 3,200 level. So just be mindful of the fact that, at least for right now, the tech stocks are starting to show some weakness and starting to pull back. Now what we're looking at is a chart of the S&P 500 for the first 3 months of 2020, so January through March. And I've annotated this chart with these simple market signals to show you how simple market signals can help you understand the risk levels and the changing risk levels in the stock market, and how simple market signals can help you manage your risk. The simple market signals are green, yellow, and red. Green is the lowest risk level in the stock market, and what you're going to find is the stock market makes most of its upward progress when the signal is green. When the signal is yellow, that means that risk levels are starting to rise, and what we can expect in a yellow environment is sideways to slightly up or down price action. And the red signal is the worst signal in the model, and you're going to find that the worst sell-offs, including bear markets, happen when the signal is red. So let's walk through this and see how this works. So we came into the year with a pretty strong stock market, as we know, and the signal was green for the majority of January of 2020. On the 27th, the signal went to yellow, and we had a yellow signal for about 2 weeks here. As we can see here, the signal went back to green for a few weeks. We know that we hit our all-time high in the stock market on Wednesday, February 19th, 2020, where the S&P 500 closed at 3386.15. And then we had this negative reversal that I had talked about in my newsletter to my subscribers, and I had told them that I did not like this price action because we did not have the follow-through. We hit that all-time high in the stock market, and then we had this negative reversal, sold off on Thursday and Friday. And so in the newsletter that went out on Saturday, February 22nd, I was warning my subscribers that I felt like something was changing and that they should be ready to take defensive measures and protect profits. And sure enough, the signal went yellow on Monday, February 24th. So I hope you guys are paying attention to how this can really help you manage your risk. And think about what happened here, okay? We hit an all-time high in the market, and then just a few days later, the model showed that there was rising risk, and the signal went yellow on the 24th. Now, over and above the risk signals, I have trend indicators in this model. The longer-term trend indicator, called the general trend indicator, went negative the very next day on 2/25. Okay, so the signal went yellow, right, on Monday the 24th. On Tuesday the 25th, the general trend indicator went negative. So there's two warnings right there, right, that something is not right in the stock market. And by the way, the general trend indicator had been positive since October of 2019, okay, since early October 2019. So think about that. The signal went yellow. The very next day, the trend indicator went negative. That trend indicator had been positive for months, okay? So there's numerous ways that simple market signals can help you manage your risk. So there's two things right there within 2 days that could have told people that they probably should take some profits, rebalance their portfolios, take defensive measures, buy puts, however you want to protect your portfolio, right? That's up to you. But you can see here how this is working. And then by Thursday, the 27th, the signal had gone red, okay? And by the way, that signal went red at around 3,000 on the S&P 500. And your first warning came out at about 3,250, okay? So, and the second one came out somewhere, around 3,100. Let's just call it 3,100. So you had numerous warnings all within 1 week. You had a yellow signal. You had a negative general trend indicator. Again, that thing had been positive for months. And then the signal went red, and as we know, the market sold off very hard from there. Guys, this is just one example, but a very recent example of how simple market signals can help protect you, okay? And regardless of whether you're trading the S&P 500, the DIA, the triple Qs, individual stocks, the correlations in the stock market they're so high these days that if you understand what's going on with the S&P 500, and my model is based on the S&P 500, but if you can understand what's going on with the S&P 500, irrespective of what you're trading, it will help you understand the general direction and the general risk levels in the stock market, okay? Because as we know, 70, 80, 90% of all stocks go in the same general direction as the S&P 500. So if we can understand what's happening with the S&P 500, it gives us a huge advantage in trying to manage our risk and protect our profits with our investments. Okay, a quick refresher on the Simple Market Signals weekly signals and how they can help you. The signals are green, yellow, and red. The green signal is the best risk-reward ratio for equity investors, and what you're going to find is that the stock market makes most of its upward progress when the signal is green, okay? The worst risk-reward ratio signal for equity investors is when the signal is red, and what you're going to find is that bear markets and the worst downturns in the stock market happen when the signal is red, like during the 07 through 09 bear market, as we see here. So again, the best risk-reward ratio signal for equity investors is when the signal is green, and the worst risk-reward signal for equity investors is when the signal is red. As part of the Simple Market Signals model, there are three powerful indicators. There's the Simple Market Signals proprietary risk level signal. There's the short-term trend indicator, which helps clarify short-term moves in the overall U.S. stock market. And a normal signal length for the short-term trend indicator is anywhere from 1 or 2 days to 7+ weeks. Then there's the general trend indicator, which is designed to stay positive during the bulk of most uptrends and negative during the bulk of most downtrends. And a normal signal length for the general trend indicator is anywhere from 2 weeks to 5+ months. We disseminate the information through the Simple Market Signals weekly newsletter. In the weekly newsletter, you will receive the proprietary risk level signal on the overall U.S. stock market. You will also receive the proprietary risk level signal on all 11 major sectors of the S&P 500. You will also receive the short-term trend indicator signal. You will also receive the general trend indicator signal. You will also receive market and sector performance information over multiple time frames. You will receive a recap of what happened in the stock market for the past week. You'll also receive technical analysis information, fundamental analysis information, and yield curve information. There is a ton of information every week in the Simple Market Signals newsletter. And a subscription to Simple Market Signals is just $19.95 per month. That's less than 67 cents per day. It's billed monthly on your credit card. There are no contracts. You can cancel anytime, and your first 2 weeks are free. And guys, I want to set realistic expectations here, okay? The newsletter isn't fancy. It's effective. It's plain text, no color, no fluff. And please note that due to international compliance regulations, you must be at least 18 years old and a citizen of the United States of America who is currently living in the U.S. in order to subscribe to Simple Market Signals. And again, that is just due to international compliance regulations. Now let's recap what you will get with your Simple Market Signals subscription. You will get the weekly emailed newsletter with all of the contents we just talked about. You will also receive special midweek updates when warranted. So if there's a major signal or direction change in the middle of the week, we're not going to wait until the weekend to get you that information. We're going to get that information to you as soon as possible via a special midweek update email. The best fit for a Simple Market Signals subscriber is an investor or trader with at least a 6 to 8 week plus time frame that they're focusing on. If you're a day trader or a really short-term trader, Simple Market Signals may help you a little bit, but the reality is Simple Market Signals is designed for those investors and traders with at least a 6 to 8 week plus time frame that they're focusing on. And if you would like even more information about how you can benefit from Simple Market Signals, I have the following videos that will be linked in the description box below this video. And to subscribe to Simple Market Signals, you just need to go to the website that you see on the screen here. That's https://simplemarketsignals.com. It'll take you about 4 minutes to subscribe. It's that easy.